Welcome. Welcome to the Northern Virginia Technology Council's CFO series. My name is Matt Swart. I'm a partner in the M&A and private equity practice here at Pillsbury Winthrop Shaw Pittman in our Tyson's Corner office. Today's program is called Capital Markets and Exit Alternatives in 2021. Before we begin, let me thank our series sponsors. Our platinum sponsors are AHT and Pillsbury Winthrop Shaw Pittman, my firm. The gold sponsors are Baker Tilly and RSM. Our bronze sponsors are Cordia Partners, JLL, Riveron, Russell Reynolds Associates, the McLean Group, and Uninet. To discuss the markets and exit alternatives in 2021, we've assembled an extremely distinguished panel of investment bankers. And let me introduce them now. They are Joe Greaves, Director of Global TMT, that's Technology, Media, Telecom, Investment Banking at BofA Securities. Mitch Martin, Managing Director at the McLean Group. Scott Stevens, Senior Managing Director, Investment Banking, Guggenheim Securities. Now, regarding the capital market, I'll just make a quick summary comment. This year, the Dow Jones has had 17 record high closings. That's in 2021. The S&P has had 19 record high closings in 2021. The S&P is up almost 10% for the year so far. NASDAQ up 7.5%, and the Dow is up 10.3% in 2021. And I want to talk about the market as a whole, but I want to get this one out of the way first. SPACs. Everyone is talking about SPACs. Bill has one, Alex Rodriguez has one, and the musician Ciara Wilson has one. The SEC last week issued a warning against celebrity-backed SPACs, urging investors to think twice before jumping in. I haven't myself heard anyone say this is a good deal because Jack is in it, but perhaps such people do need to be cautioned. SPACs in the U.S. have raised $87.9 billion so far in 2021. Already exceeding the $83.4 billion in total SPAC issuances in all of 2020. So that's $171 billion in SPAC money out there looking for companies to buy. I read that there are more than 400 SPACs looking for deals right now. That's a lot of money and a lot of SPACs chasing a finite number of good companies and inevitably bidding up the prices. So let me apologize in advance for a Scrooge kind of question. But isn't this going to end in tears? Is this Sox.com all over again? And maybe you can give us a minute to understand SPACs as potential buyers. Let's assume no one in the audience is considering making an investment in a SPAC, but might see a SPAC as a potential buyer. So Scott, Sox.com, where are we?
Maybe Pets.com. I'm not sure there, Matt. But it's a pretty interesting kind of like market structure that we have here, where it takes a few different combination of factors together to actually get us to this point. Number one, you've got really, really, really high public company valuations, right? So that creates a window to where there's a dislocation between public and private valuations, and why companies are willing to go down this path of a SPAC, like to try to sort of catch that extra incremental bit of value that they could potentially get in the private market. And then you've also got like a significant amount of friction in the traditional IPO path, right? So if you look at how companies have traditionally gone public, where they priced, how that's worked, the execution there's been a significant amount of, concern and frustration with how that process has gone. And so you take this sort of two factors together, and people have looked at this kind of SPAC path as a means of trying to get public, number one, on one half, and number two, capture some incremental value on another. And that's it's a sign of a bubble, right? It's definitively a sign of a bubble. It's a sign of very frothy markets, and it's not, I would say, an artifact of a really healthy market. My first SPAC I did in 2008. I'm pretty sure I still have scars walking down the back streets of New York when I got that deal done. The world's slightly different now, but at the same time, the structure itself is not not the most traditional kind of approach to getting a company liquid. And in that context, I think you're right. Seeing a bit of a top, by seeing that kind of approach, that kind of structure.
Okay, well, and Joe, just to pick up on that, I guess it certainly sounds like my experience with SPACs echoes Scott in the sense that at least the part of it, which is the IPO process, is just so hard. SPACs form a bit of a shortcut, but it's almost become an investing category of its own. And if you're a seller, isn't all this SPAC hype and tremendous level of SPAC investment basically good news? I mean, what's your sense of the market?
I think it's definitely good news, and it's really a source of capital that's, I think, is here to stay, Matt. And they've proven that. I don't think it's going away. I chuckle a little bit about Scott talking about the back streets of New York. I worked on one in 2016, and I think even at that time, like, it was a 4-letter word. The SPAC was almost like a Hail Mary. If you were running an M&A process, we told our clients that we are going to actually contact the SPACs. It's like, okay, we're at the last straw here. This deal's on life support. Today, it's a completely different animal. You have real money who's really looking to deploy that capital, and from some marquee investors. But at the end of the day, the important fact is the target that they're going after from the SPAC or the company that you're talking about, they're going to be a public company. And I think that's one of the things that some people says, hey, some of our clients out there today are like, should we be considering a SPAC exit as well? The real question I have for a lot of them is, are you public company ready? Because yes, the IPO process is rigorous. The IPO process takes time, and there's a lot of diligence that goes through it within the bank. The whole syndicate doing the research, you educating the research analysts. It's a time-consuming process. And at the end of the day, the company's evolving and telling their story and figuring out how to be ready to be a public company. But at the end of the day, you have to be ready to be a public company. And I think the good success SPACs that are going to be here to stay, I think they're finding targets that are good public companies that have a story that they need to tell to get the market to understand it. I think there is a little bit of frothiness in the market today. You can see the amount of capital out there being raised by SPACs. And I think some of that, to your point, could end in tears. But I think the good thing is, if those SPACs don't find a target, they really have a 2-year horizon, and then that cash gets returned back to the investors. So it's not like this is going anywhere. It's the one, if all of those end up finding a target and going out to become public companies that aren't quite ready to be a public company, I think then we could have a much bigger crisis on our hand. But I don't think that SPACs are going to disappear. The fact that you have some of these guys who are prolific investors, when I look at Churchill Capital, like they're on their 7th or 8th SPAC now. Foley, you have multiple iterations. I think these guys are really here to stay, and they provide a halo effect and some oversight to the board when they come in to find a target that they're willing to merge with. So I think there's a lot of benefits they do bring to their targets. It is a different source of capital and a different path to getting public.
It's interesting that you mentioned that, and we'll get in a few minutes to kind of what makes a company ready for an IPO. But I've always felt that when we have exit panels, or when people talk about exits, they lump IPOs, and now we're saying kind of as a way of going public, in as an exit. And it's not really entirely an exit, at least for management or founders, right? I mean, it's sometimes an exit for investors, but if you don't get your money out in the IPO or in the SPAC acquisition, getting it out later for insiders is a lot more complicated, right? So it's like, would you say, Joe, that IPOs or SPACs are necessarily exits at all?
I don't think they're exits. I think they're paths to liquidity for your team. I think that's the most important factor, is the management team and a lot of the employees. I mean, if you're working in a private company, they've been there, putting sweat equity, and they have equity on paper that's worth something, but how do they actually monetize that? I think that's what motivates a lot of the startups and the early stage companies that are private and experiencing significant growth, in particular in the software space, is they want to have a path for their management team to monetize their wealth and their investment that they put into, the blood, sweat, and tears they put into building that company. I don't think it's an exit as an M&A trade would be, and there's definitely a different feel. I think one of the jokes I always hear about the IPO market, it's like the maternity ward of investment banking. You get a good IPO done, everybody's happy. As opposed to a good M&A deal, I feel like everybody's got to be a little bit upset, and it was a good deal, but both sides are slightly upset. And you met in the middle. The IPO has that fanfare around it. But I think that's one of the big things that I think the SPACs, I think people overlook, that they don't quite offer the client, is when you go through an IPO, you have your marketing process, you're out there meeting with investors, and then you have the whole fanfare of the actual ringing the bell, your trade. It's a huge event for the company and a huge marketing event. I think some of that gets lost in the SPAC transaction. While yes, you do end up going public, you end up having a public currency, you may have a few different advisors coming onto your board, and that may be advantageous for you and what you're looking for. Don't get the fanfare of the IPO, the marketing event of your brand being uplifted. You're not in New York. I mean, well, some of our clients have been doing it virtually over the last year, ringing the bell. But there's a lot of fanfare that I think it actually helps increase the company's brand, their presence in the market, and actually puts them on the map, for lack of a better term. And I think that's one of the things that people overlook in the between the SPAC and the IPO is that marketing cachet that comes with the IPO, as well as the research syndicate that you get from day one.
So, Mitch, let me ask you, you spend a lot of time with middle market and lower middle market, government services, aerospace, and defense companies. From the level that those companies are seeing in terms of interested bidders, have you found the SPAC prevalence or activity to affect kind of the outlook for those companies?
I to some degree, and obviously everybody's watching it. I mean, and I, to some of the earlier comments, and certainly that's what we've seen. I think, a potential concern is obviously the dilution that occurs during that chain. When you talk about the founder's shares, you talk about sort of that initial warrant issue, obviously any discount to the pipe. And then Matt, as you mentioned, if on the back end, you're paying a premium for the company. So I think, institutions can do pretty well along the lines. Obviously sellers in the right circumstances can do pretty well. I think, back end shareholders, it's sort of an open question and very, situationally dependent. I think what we see in our market, and, as getting ready for this panel, I went back and looked, okay, the last 9 months, what are all the SPACs that have occurred in sort of that defense government sector? And it tends to be in emerging, I'll call it emerging markets. Quantum computing, you see a lot of space infrastructure, you see sort of a lot of kind of higher end cyber and analytics type companies. And I think it's an interesting dynamic, and I'd certainly love to hear Scott Joseph's view on it, but I think you can have smaller companies that can obviously go public through a SPAC. I think also valuations tend to be quite a bit higher than maybe a more generic services company, for example, but they're also, there's a wider left and right. So I think you can justify a certain valuation with those types of companies where, the future is much more speculative than you can with others. And I think that plays into why we tend to see those as the SPAC candidates in our market.
Well, correct me if I'm wrong, guys, but you read what a SPAC intends to do in their public documents, and it'll say, we want to do cybersecurity, or we want to do telecom, or whatever, and then they start to list out other possibilities and basically say, and anything else that looks good, right? So they're theme oriented, but in that hugely competitive environment, they have to be able to be kind of opportunistic, right? Like they'll pick up, in my experience, having represented a couple of them, they'll be looking at a fintech deal one day and a completely different, hospitality or transportation another day, just because there's so much competition for deals, right? I mean, is a well-funded SPAC going to turn away a good company just because, they originally planned to do fintech and instead this is, communications technology? I mean, no, right? So let me get to the next question, which is kind of related, and I'll start with Scott. I mean, as a seller, and having worked as a seller to advisors, in fact, as an advisor to sellers, and in fact, we've worked together in that setting. In a competitive bidding situation, aren't SPACs at a disadvantage? I mean, if you're a seller and you've got reasonable offers from different categories of buyers, let's say you have offers from strategics and offers from private equity funds and one or more offers from SPACs, I realize you can't really generalize, but at least private equity funds and strategics don't have to go back for a shareholder vote to kind of get the deal approved. Doesn't that make them less competitive, Scott?
Yes, right. And a SPAC really is an IPO, right? An IPO is not an exit event. An IPO is historically has been a fundraising event, right? And so if you look at it that way, yes, SPACs are at a massive advantage to traditional buyers, right? And how traditional buyers view, an M&A process, and how sellers view an M&A process. So, we actually can't, or historically have not run a SPAC process like right on top of a sell-side M&A process. You either have to decide up front if you want to go down that path, or it's the approach you take on the back end of, a quasi-busted M&A process. You can't really do it, in parallel with one very effectively, because in part, you're dealing with an entire IPO process, which runs in parallel to a sell-side approach, which, you can't run those things on top of each other. They really become, overlapping. So yeah, it becomes a poorer buyer of a business for full liquidity on a full liquidity basis. And you have to have, I think, a real kind of premium from a value perspective to go down that path.
So, and I'll go to Joe and Mitch to follow up on that. Is it fair to say that when you're sitting down with a new client, which is a solid company with good prospects, for almost any kind of deal, let's leave IPO out of it, but for a good private equity or strategic exit, and they say, look, I keep reading about SPACs. What about that? Your sentence would probably begin, well, that's a very different kind of transaction. And then what would be the rest?
So I think it's definitely a very different kind of transaction, but I think, Matt, the important thing, I think, alluded to this at the very beginning, why they are getting the attention of sellers is because of the disparity between the private valuations and the public market valuations, because they are able to come in and you're actually able to kind of do the price discovery process before you even go out to the public markets. Now, that still has to be validated in the public markets once you agree to the deal and go out and go get your vote from your SPAC investors. But they are able to come in just where the public market valuations are today. If they can position the company correctly and have the right comp group, come in with a quote premium valuation. I would say in a normalized market, we don't think you're going to be able to have the same fever that you would from the SPACs and coming in offering premium valuations, because if that disparity shrinks, you're not going to be able to realize that value uplift public markets that you would be able to get from having your immediate source of capital from a private equity sale or from a different type of investor through a regular way M&A trade.
So if you guys, and I'm bringing Mitch into the conversation, let's say that you're brought in to advise a company board, and they're saying, there's one or two directors. It's like, I don't know, the public markets are so hot. Why wouldn't we take advantage of it? And of course, there's a risk associated with that, which is that you better hope, if that's your plan, you either better hope to get out while the market is still hot, or hold on long term while the value kind of, it was sort of plan to hold it for a while, right? So there's another dimension of risk in a SPAC. It's just and how do you help a client evaluate that?
Yeah, absolutely. And frankly, that's where we're in the middle of a number of those conversations right now. And I think it's exactly what you said, Matt. I mean, you kind of lay out all of the strategic alternatives, the pros and the cons. We're absolutely certain clients, they want us to bring them SPAC options. And we certainly do that. I'd tell you to date, we haven't, to date, it generally hasn't made sense for our clients. For kind of all the reasons that you mentioned, and fundamentally, as you said, I mean, you got to want to be a public company, and really this is a capital raising step, and you got to want to have sort of bigger ambitions. And generally speaking,
and say that if you really want to be a public company, you should try hitting yourself in the head with a brick first. And like that. I'm sorry. I'm kidding. It's a whole different life than a private company. I interrupted you. Sorry. Yeah.
It definitely is, Matt. But I also, and I think about it. One we're working on right now. You do it it's almost in series, not in parallel, where they're thinking about an exit, and it's a private equity investor. I mean, a sizable company, multi-billion-dollar company. But they went through and we did a market check first from a sales process, didn't quite hit the number that we want to do. This goes back to the disparity in the public and private market valuations. And then we pivoted, all right, we are going to go down the public equity offering route. And then the question is, do we do SPAC or IPO then? And we had an inflection point where we had a couple conversations up front with a few select investors. But it goes back to, all right, unless we're at one of these special, unique SPACs that have no warrants and there's minimal dilution, we don't want to dilute ourselves and bring on that incremental dilution when we have the ability to go down and do a successful IPO. And I think that depends upon the client and the business itself too, because if you do have the ability to go down the regular way IPO process, you're much more in control. You're able to go out and market, pick your investor, allocate your book as you want to, and pick your long-term shareholders, because you're going through that marketing process. As opposed to the SPAC, you're basically taking the rented capital with a partner that you have, and then you have to go out and market and recycle that capital. So it's a little bit of a different story. And I think most of our clients, they think they can go the regular way IPO. It ends up being that's option A as opposed to going down the SPAC route. But if you have that that hair on the story where, hey, I need to tell something that what we're going to look like in 3 or 4 years and get the market to understand that, then the SPACs provide an excellent.
So that's actually a good segue to talking about IPOs generally, and I think my analogy of hitting yourself in the head with a brick is a little overblown. I would say more like try walking 10 miles with a pebble in your sock. That's more like what I think life as a public company might feel like. So the IPO market right now is pretty active, right? I mean, there's some well-known names that have consummated IPOs in 2021: Coursera, Vizio, Poshmark, and Bumble, just a few. For Scott and Joe, who do a lot of work in the public capital markets, what does the 2021 IPO market look like? And just as a quick note to that question, there was a time when I started practicing in 1995 in Silicon Valley that smaller IPOs were common. Growth companies raising less than $50 million were underwritten by major investment banks. It feels like that's long gone. So we'll get to IPO readiness in a minute. But what does the market look like, and what is a public ready? What does it take to go public this year? Clearly not a growth story and a hope to raise $35 million.
Yeah, go ahead, Joe. I'm happy to pile on after you comment.
No, I think it's interesting, and I would say over the last years, growth has been key, especially in the software and technology space. Everybody was clamoring for growth. I mean, there was one point where you were almost getting one turn of revenue on forward revenue for every percentage of growth. So if you were growing 30%, you were almost getting 30 times forward revenue multiples, which seems very frothy. But I think it speaks to, in the software space in particular, how much emphasis and value was put on growth. That is what investors were seeking. And you're right. I think the size of the last decade or so has definitely crept up from what it used to be in the $50 million offerings. You're definitely trying to have, I think the sweet spot we've been telling people has been between 150 to 200 million of run rate revenue is typically where the sweet spot is today. And the averages have been increased by some of the larger deals. And you think Uber over the last couple of years, Airbnb, you've had some big companies come out and go public. But you've also had some other companies that I would say are on a smaller scale. And I actually think we're seeing that creep down a little bit. I don't think it's going to get back down to the $50 million offerings where you're going to have those as the regular way IPO. But I do think it is coming back down to that 100 to 150 zip code of a revenue business, where now of scale, you can go out and actually attract an investor base that you can bring in and actually get demand for your stock, because that's also one of the important things with the IPO is it's a momentum game. You want to have the momentum when you're out marketing and raising capital.
Yeah, and it's a structural issue, right? If you can't do a 50 million IPO because the institutions who you want in your stock can't get a big enough allocation to do a $50 million deal, right? Wellington's going to look at that and not want to do that transaction because it's too not enough money, and that's really where it's become a capital issue in the sense where these complexes on the buy side have gotten so large where they have to put more money to work, which has actually forced them to move into the private markets to write checks and make sense for them, and has made the small cap IPO something that just does not work, right? And so that's had all kinds of knock-on effects. People have raised more money in the private market, stayed private longer. It's made the IPO an exit event, not necessarily a capital raising event. And it's made, I think, John Q. investor, put that person in a bad spot because they're not able to actually buy into, the next Amazons and Microsofts, because a lot of the return has actually been driven in the private market. So there's a structural issues there, which is, I would say, not great, from a U.S. capital market perspective, but it's sort of just part of, where we are right now, just based upon the size of the buy side funds and the complexes that exist there and what they need to drive their returns, where you just cannot do a $50 million IPO and have that be something anyone's interested in.
It's interesting. This problem, ever since, people don't really talk about it anymore, but Sarbanes-Oxley was blamed wrongly for the change, and it's gotten a lot more expensive to go public. It's changed the type of public offering. And Bob Grady, who was a partner at the Carlyle Group, as far as I know, he still is, I don't know, and the president of the National Venture Capital Association, had this opinion piece in the Wall Street Journal where he said, look, you just look at the number of IPOs in the United States from pre-Sarbanes to post. Now we're way past Sarbanes. I mean, we're probably 20 years past it or close to it. It's radically changed. So his position was American competitiveness is affected because, at one time Cisco was viewed as a great company. It still is a great company, but it was truly a superstar of its day. And his point was, had Cisco been acquired by IBM, it might not have accomplished what it ultimately accomplished. So we have a different landscape in these decades than we before. I guess the question I'm asking that I'd be interested to ask you guys, and again, we'll get later to what it takes to make a company go public, but when you're talking $150 million revenue or thereabout, we're kind of homogenizing the types of companies, meaning, you have highly polished professional management teams. You don't have the swashbuckling kind of people. They're typically transitioned out and more professional management is brought in, right? And that's okay. I mean, I guess what I'm saying is probably investment banking looks different today. It looked, when we were doing smaller deals, and maybe that's okay. It's a lot to go on, but I'll bring you back to one question. What does the 2021 IPO market look like? I mean, I'm sure if you haven't already begun serious planning for an IPO in 2021, it's hard to say you guys could get them on the market, right? But talk to me about that. What does the market look like? And what do you see coming in the rest of the year and maybe even a little after that?
So I think the 2020 IPO market is going to remain very busy. I think we even took a little bit of a pause, I would say 2 weeks ago. Market pulled back slightly. We had a number of our clients that were on file confidentially. We were sitting here, did we miss the window? Is this really is it going to evaporate? We had almost a little bit of a buyer strike from some of the investors. There has been so much capital being deployed in the IPOs and in the pipes that there was a period where there was a little bit of a pullback, and it was like, no, this could slow things down. Now, fast forward a week or two, and the market responded, and I think you're now seeing consumer sentiment changing and a lot of positive tailwinds that I do think the rest of during the summer is going to remain strong. There's a couple of them that priced last night that should start trading today, and then we're on file for a couple other large software IPOs that have been flipped public, PowerSchool being one of them, and a few others that are out there. UiPath actually out there in the public. I think they just launched their roadshow yesterday. So I think you're gonna see a number of other companies come in who have been preparing flip public in the coming weeks, and I think that's gonna hopefully build momentum in the IPO window, and should see that be very strong, I would imagine, throughout the summer. I'm not sure it's gonna be the same as it was last summer, but I think we do feel pretty good about the 2021 IPO window so far, and the market backdrop I think is providing a lot more consumer confidence, and I think we're still seeing risk on from the investor appetite.
And Scott, your forecast 2021, even a little beyond, what does it look like?
I'm not sure, Matt. I mean, it feels like the late 90s, right? I'm starting to twitch a little bit here every time I see, the next sustainability or electric car company going public at crazy valuations. It just feels like, I'm going to see Webvan Part 2, like, here in how you're seeing the capital markets kind of work. But the scary part is these things can last for a while, right? And so you can come here and say that the market's going to turn sideways, and a broken clock, you're going to be right twice a day, right? Like we can sit here and look back and go, oh gee, well the market did turn down, but you can miss like a huge bull run because the market ran for a couple of years. And so in our business, you go to your client and say, well, you shouldn't go public for reasons X, Y, and Z, and then you see 5 companies go public for reasons A, B, and C, and you're wrong, right? Because the reality of it is I have some serious pattern recognition from the 90s, but I don't know if it's 1998 or 2000. And that's where you look at the market and you go and you scratch your head a little bit because the fundamentals of capital formation, and from a capital markets perspective, aren't perfect right now, but I'm not sure they have been perfect. And right now it's really distorted, especially if you look at like where the Fed has rates and how, the overall market is working. So to answer your initial question, like, what do I think about the IPO market? The short answer is I have no idea, right? But I know this, like the bar is serving and people are going to drink. And if the capital markets are open the way they are right now and valuations are where they are, you're going to see a really robust IPO market, for better or for worse. And that's what I think we are for the foreseeable future.
Yeah, it feels like people always talk about the IPO window, which implies that it's a changing thing. You open it when it's hot, you close it when it's cold, and so that's always been true. And it just feels like things are very hot right now. The window's wide open, but don't leave your fingers stuck in there for very long because we don't know, right? All you can do is be ready, I suppose.
Well, Matt, I was going to say too. I mean, and we talk about, and I think Joe mentioned that, obviously we're seeing a lot of this activity because of the premium that we are seeing in the market. I think everybody agrees there probably are some headwinds, whether we talk about taxes, whether we talk about, sort of budgets or whatever that is. And, I do feel like, and we've talked about private equity and the amount of sort of dry powder and capital that's waiting there. And I think to the extent that the equity capital markets do come down, there's a group that's waiting there. So I think, potentially you do see some of those transactions go the other way as well.
Well, it's interesting, Mitch. I was going to ask you if in the government services, aerospace, and defense market, you're feeling, my sense of the market from doing some of it myself is that the valuations are really strong this year. This is a great year in valuations. I'd be interested in your perspective. And let us know kind of what subspecies, what sub expertise is fetching even the highest multiples within the government services market.
Yeah, absolutely. And I think I'd certainly agree. We're seeing a lot of activity and we're seeing very high valuations by historical standards. And I think there's a number of reasons for that. Frankly, I think there was some sort of pent up demand from the strategics. During the COVID period, you had probably a couple quarters where strategics were on the sidelines to some degree. You did have private equity filling that gap, but I think now, whether you're talking about Leidos or some of these, you're seeing them back in the market and you're seeing very healthy valuations. I think just to kind of reiterate it again, the equity capital markets, if we look at our traditional services index and we're trading it, right now, I think the index we look at, we're probably on average, it's trading at about 15 times EBITDA. And historically, that same indices would be, 8 or 9.
That's amazing.
Right. So, when you have that premium, I think it's a lot easier. It's a lot easier to justify paying a premium to make the acquisitions. Obviously, if you're using shares as currency, that's less expensive. I think it's also, frankly, it lends itself to sort of what I think is, a big shift in private equity, which we saw a lot of new players coming into the market during the COVID period, and I think government services or government in general was looked at as a little bit of a safe haven, but frankly, what they're able to pay, they're looking at the equity capital markets and they're trying to forecast, okay, on the back end, what is going to be my exit? And with valuations where they're at, we are seeing some premiums there as well. And then just the amount of money, obviously Veritas has been extremely active with Peraton and obviously recently with Cubic and, that there's just a lot of capital that needs to be deployed. And, there's some pretty smart people that are out there making these plays.
Yeah,
go ahead, please.
Well, I was just going to say, if you look, private equity came pouring into government contracting after 9/11. And if you looked at the sort of pitch books or the book distribution list that investment banks put together before that, there'd only be like 2 private equity funds in the country that would look at government contracting deals. In fact, when you looked at what the fund would invest in, they'd say, we don't invest in entertainment, restaurants, or government contracting. Now that's all changed, right? Now people are in. And I've asked in similar meetings in the past, have tourists gone home? Did the tough times? And the answer seems to be no. Private equity is here to stay in a big way in government contracting. And what's interesting about that, and if you kind of look historically, where we saw a lot of it come in was kind of at the height of the market, I'd say, with the OCO spending, the overseas contingency spending, and kind of that 2006, 2007 period is where a lot of those buys occurred. And then, frankly, a lot of those exits were coming around sequestration and a lot of these folks didn't get the returns that they were necessarily looking for, but you talk to them and many of the funds are here today and they're still very active. And it was sort of hard lessons learned where they kind of said, hey, it wasn't necessarily the outcome that we wanted, but we got to know this market really well. And so, yeah, this is fundamental to what we do now. Interesting. God, we could have a whole panel on private equity and the prices they pay in. And then, because I hear from private equity people that they're feeling priced out of deals all the time, but yet it's their business to do deals. So that's an interesting topic. Let me ask Joe and Scott about the differences between an M&A ready, an acquisition ready target, and an IPO ready target. It's a very different profile, right? If you sit down with a management team and they say, well, we were thinking about selling the company, but we're interested in going public too. What are the things that you might immediately say to say, is an IPO a valid alternative for the near term for you, sample client? It's a jump ball, so whoever wants to answer first, please go ahead.
I can go. So what would you say if your client's asking, option A or option B?
Well, they're saying like, yeah, we finally built something we really like, but we also realize we need to get some value for our shareholders, and I'm getting old and I'd like to make some money, so either an exit, either a sale or an IPO. I mean,
I think case by case basis, and a lot of it's driven by the motivation of the owner. And if it's a founder-led company who may be young, call them in their 40s or 50s. I think it's a different conversation than if it's a company founder who may be later in their life, in their 60s, looking to monetize fully. I think that is one of the key motivations when we're figuring out, hey, what's the right path for you in this specific case. A lot of times you have the founders who are maybe have this startup company, they've been put the last 10 years into it, but they may be 50 years old, 45 years old in the tech space, and they still have a lot left in their career and a lot they still want to impact, and they may not want to exit completely. And I think the exit from an M&A perspective is much different than it is from an IPO perspective, because it's not really a true exit. It's much more of a path to liquidity for everybody. And in like you would have multiple shares, you can act multiple classes of shares. You could end up structuring it different and actually maintain control of the company in a public offering, as opposed to if you end up selling, you typically may lose control and you may be working for somebody else. So I think a lot of it comes down to what is the motivation of the client and what's the best advice for them in particular. But from a readiness standpoint, yes, I think there's a lot more preparation in my mind that goes into making sure your public company ready and your reporting and your ability to do your financial reporting is ready from the IPO perspective. Now, you don't have to have that all done on day one. You can do that throughout the process. It may elongate the process from the accelerated 5 to 6 month timeline. It may take you 9 months to be fully ready to go public, as opposed to on the M&A side, you could probably do the preparation work and have everything done and ready in a much shorter time frame of call it 4 to 6 weeks. Scott, I don't know if you have a different view.
No, I think one point I would say is that if you're selling a business and you've got a founder-owned company where you own some vast majority of the business, you're probably not selling everything. If you're selling to a private equity firm, you're going to roll a bit, right? So this notion of I'm either going to sell my company or I'm going to take it public. Taking it public has traditionally been a fundraising event, not an exit event. So to Joe's point, it gives you an opportunity, a vehicle to eventually have everyone get liquid. That's a journey, right? That's not like an event, right? It's definitely a journey over a period of years. But if you're selling the company now to a sponsor, you're rolling, right? Are you rolling 20 to 35% of your after-tax proceeds? Probably. Are you rolling 50+% in some situations? Sometimes, yeah. So it becomes a multi-step kind of process to ultimately get liquid. And so these become, I would say, problems that are good problems to have. But this notion of, hey, I'm going to sell my company for $100, I'm going to get $100 tomorrow. Yeah, no, it's not exactly 100% the case. And so when you look at like an IPO kind of outcome, versus a SPAC outcome, which is sort of a hybrid approach versus a sell side, these things are never like, hey, I'm going to get $100 today or $0 today. If I'm going to sell my business or take it public, the truth is probably somewhere kind of in between. But like all markets right now are just really robust. And so, it's like one of those things, if you're trying to get liquid, right, and you want to go, you want to sell a house right now in certain parts of the country, go sell your house, because I'm not sure, how much better things are going to be in the next 10 years than they are right now. Similar, I think, for valuations in most markets for businesses, like if you're on a cruise line or a restaurant, life is pretty good right now. So let's kind of go figure out how to get an outcome. And while it may not be 100%, outright sale, you're still going to be able to crystallize a big chunk of your value right now at a pretty good price. So.
Well, and so if someone says, look, and in my experience, one of the arguments for an IPO is what you might call legacy. I mean, someone says, I don't want my company to disappear. I put so much time into it and it's sort of my baby. I want to see it last on. And that's an argument people use sometimes for IPOs. But there are things that, you could be ready, and I think you mentioned this, Joe, but you could be ready for a sale quicker than you could be ready for an IPO, right? There's just very measurable differences in those two things.
Yeah, I think it's a simplification of it, but yeah, I think the preparation process, there's a number of things you need to prepare for from an M&A sale perspective too. But the robustness of the diligence with the banks and the multiple banks involved in the syndicate elongate the preparation for the IPO. It is a longer process, but I think a lot of that is when you have a founder-led company, it is the legacy issue. I mean, their baby. If they've built this from the grounds up, it's a much different conversation than if this is a sponsor-owned company that maybe has a CEO that's an operator, who's operating partner who's come in and is running the business. That they have a different view of the outcome and the success for them. It can be binary as, hey, an M&A trade is just as good, and may actually be preferred. So I think it's dependent case by case. But I think Scott made a good point. The IPO is typically a fundraising activity, but can be viewed as an opportunity for you to leave a lasting legacy and still maintain control, and entire control of the business, as opposed to the M&A trade. You may not be taking some money off the table, but you don't need to take all of it off. But you could actually be giving up control or a sizable amount of control as opposed to in the IPO process.
So I guess it's interesting from the company perspective too. I was involved in an IPO once. We filed the registration statement. The company's all abuzz. Everyone is so excited because, as you've all observed, it's a marketing event for the company. It turns a company from maybe known to a celebrity. It's in the newspaper. People are speculating what it's going to be like. And then in the middle of the registration process, they were acquired. I was there at the company when it was announced, and it's very sad to watch the expression on the faces of the team members, because I think they really felt like, they had thought of life as an IPO company, and now all the uncertainty in their mind that comes with an M&A exit is there. And M&A has gotten a bad press. I mean, M&A almost always is viewed as you should be scared about your job. Now, the reality is, I think very often acquirers are keenly interested in keeping the team motivated. But I guess the question is, if you're not going to do a public offering and you're going to do an M&A event, isn't it an enormous challenge, Mitch, to figure out when to bring kind of the key team into the knowledge circle about an M&A exit and how to position it to them? Because people will immediately get defensive about them losing their jobs and kind of what they're going to get out of it, right? I mean, isn't that a big, important part of the process?
No, absolutely it is. And I think, what we tend to see is that people are kind of read in various stages. At the front end, you tend to have a very small circle. The ownership, the leadership team, folks that are aware of the transaction. As it's move along and as it becomes maybe more clear or more likely that a transaction is going to occur, oftentimes some additional folks will be read in, both, additional leadership as well as, as we've all said, M&A, any transaction takes a lot of sort of capacity and work, and you need people that are going to help populating data rooms and things like this. So you start to widen the circle. And then, generally the announcement to the employees, you don't do that until the transaction is complete and consummated. And I would say good buyers especially are very deliberate and very good about scripting out exactly how that's going to go, making sure that you have your FAQ kind of question, you're able to right out of the gate be able to address any concerns employees might have. Are my benefits going to change? Things like this. So I think it's extremely important, and most of the work we do is with very people-intensive businesses, and it's a small industry too. You see the buyers that have not done well with it, and you have sort of this flight after the transaction, and then you see the ones that have done very well. But I think just being very deliberate about it is extremely important.
And for Scott and Joe, I mean, isn't that a key? I mean, have you seen deals really jeopardized by the failure to manage the people side of it at the target? That is poor, non-strategic in timing of informing the team or the employees, vagueness about what the post-closing world looks like. I mean, what would you guys say to the importance of how the target manages their own team in an M&A process?
So social issues are huge, right? And you can't get past that. I mean, what I say sometimes, every process we run, there is a life's too short list or a hell no list of buyers that people will not call, right? Because they just do not want to be part of that business. And, I view it as advisors. Our job is to deliver options. Your job is to choose like the next phase of your life as a corporate entity. And that is, as human beings, you have to choose who you want to go work with. And so do does how employee 75 through 750, does that really like swing what happens in a deal? No, it doesn't, right? But does what happens to the top employees at a company, is that a very important factor in how we run an M&A process? 100%. And then when you go and you do a private equity deal or a strategic deal, what happens to those main buyers, or excuse me, those employees with the buyer? That is a huge driving fact. So like, I do a lot of businesses in software and then a lot in services. There's a very big amount of consideration set aside for management, right? Forget about shareholders, for management of driving value in the next phase. And is that 8 to 12% of equity value in the context of a private equity deal? It is. Or is it, a big kind of like holdback, if you're a strategic buyer, of a services company, 100% is. And so, the people piece of this is very, very significant. And I would say in almost every single deal we do, there is a hell no list where, management comes back and says, I'm not going to get bought by that company. And, we as advisors have to respect that.
Yeah, go ahead. Yeah.
No, I was going to agree. I agree completely with Scott. And I think that hell no list, I think it definitely happens. And depending on the unique circumstances, if you're running a go shop, for instance, you may end up having to contact some of those parties, but it can be very nuanced on, hey, I want to make sure we position this the way so we get the outcome that we want. You don't want to, there's definitely, the social issues are huge. And I think it can have big implications on the success of the business post closing. So ignoring them we would be remiss to not point them out. But I definitely think there is that aspect of, hey, I want to dictate where this goes. I want to dictate who are going to be our long-term ownership or our long-term partners, because it doesn't just stop as soon as the deal closes. You're now living with them, and it's a marriage. Like you're moving forward and moving forward together.
So unfortunately, we only have about 10 minutes and a number of questions we really want to address. So I'm going to ask you to address the next two quickly so we have time for the last one. So here's what we have right now. Corporate and individual taxes are definitely going up. The majority party in both Congresses and the president have said so. The rate difference for long-term capital gains may be diminished or even abolished. Interest rates may also be going up. How are these extra costs going to affect deal volume and valuation? Will the behavior of the different kinds of buyers change with these new costs? Let's go with Mitch first.
Yeah, absolutely. I think, fundamentally, the value of anything is the present value of future cash flows, right? And obviously, if more taxes are being paid in the future, and that's sort of a shift in the forecast, we would reasonably think that there should be an impact on valuation. Now, we've talked about sort of where the equity capital markets are, and we've talked about sort of the behavior, whether it's rational or not, but at the end of the day, we would anticipate a shift there. And I think many of our processes, certainly taxes are driving a lot of that. And taxes, people are saying, hey, if I'm going to sell, this seems to be the right year for capital gains reasons. And it seems to be binary. Either it's, we're looking at doing something and getting it done this year, or we have a longer term strategy. We don't have too many people talking about closing, Q1 of 2022.
Yeah, and so the Wall Street Journal, I think, described where we are now as the golden age of taxes. But Scott, taxes going up, interest rates. Obviously that drives some behavior now, but will it constrict deal flow in the future, you think? With less money to spend, basically, because it's being used on taxes and government. What do you think? And taxes and interest rates. What do you think?
Yeah, the short answer to that is yes. The longer answer is the world is awash in capital, right? It's crazy the amount of money that's changing. What I describe as not very many good, positive NPV projects if you go back to basic finance, and because of that, we're gonna, I think, still see a robust M&A and IPO market, because where the hell are people going to put their money, right? You can't your checking account get a return, right? If we get into a situation where interest rates really run, in my view, we got bigger problems as a country and economy because of where we sit from an overall debt load perspective. I think we're going to be like in a Japan style, like sideways malaise for a very significant period of time, where cost of capital is going to be relatively low. And people are going to be like looking for places to put money. And so, yeah, could taxes go up? For sure they are. Could rates go up? Yeah, for sure they are. But but I'm not sure how people go do with their money, right? And so I think in that respect, our markets kind of stay still robust. I think with the windows opening and closing to some degree based upon, where debt capital markets might be at a given point in time, what have you. But, I don't know how people get away from the dynamics of there's way too much money, way too few good places to put it. And so asset prices are going to be high for the foreseeable future, even with taxes and potential interest rates working against us.
Well, that's a pretty scary environment for investors, isn't it, Joe? I mean, high taxes, high interest rates, and high valuations. Like, how do I make any money?
I think you're right. But I agree with Scott there. I think things are going to change over the long term. I think next couple of years, but I do think people are still going to be deploying capital because there is a ton of capital on the sidelines. And where are you going to put it? I think you're still going to see, I think maybe in the software space, people valuing that growth, those growth assets, and realizing the ones that are really providing a digital transformation to their industries. I think those are some of the winners in this space where you're going to see, all right, there's real growth opportunities here and real value opportunities for people to actually deploy their capital. I think that we're still going to see the market be strong over the next couple of years. In particular, I mean, the consumer sentiment's changing, like the economies are starting to open back up. I think you're going to see consumer spending, and I think you're going to see a little bit of an uplift over the next couple of years. Now, how fast interest rates do get raised and how fast the taxes do come out, I think will impact value in the long term. But I think in the near term, we're still going to see momentum in the market.
So with our remaining time, I want to talk about a topic that is just always interesting, which is what drives blockbuster valuations. I was interested to hear Mitch, talk about 15 times in the composite of aerospace and defense. And that, to talk about a 15 times multiple on a government contractor, even, 5 years ago, let alone 15 years ago, you would have thought, I mean, that's a once in 10 year kind of thing. And now they are happening, right? They're happening all the time. But even more than that, there are the deals that make mega headlines. And I'll go through some examples that are kind of famous. eBay bought Skype for $2.6 billion. Now, and each of these examples, I think it proves out for the buyer that it wasn't necessarily in the long run a successful deal. But the point was, they paid a lot. Microsoft bought Nokia for $7.9 billion. Yahoo bought Tumblr for over $1.1 billion. And then incidentally, after Verizon acquired Yahoo, Verizon sold Tumblr for an amount reported to be around $3 million. So the question is, if I'm a seller and I'm sitting there and I'm saying, yeah, Mitch told me 15 times people are getting it, that's interesting. I want to beat everybody. I want one of those valuations that changes the front page of the Wall Street Journal. That's a crazy multiple. Call me a GameStop guy or whatever, but I want people to wonder, why are they paying that for my company? How do those things happen? I mean, how do the outliers on the positive side for sellers happen? And, is it just you happen to hit a particular moment and a particularly, dare I say it, like unrealistic buyer or desperate buyer? What happens, Joe? How does that happen?
So I think a lot of it is typically it will be a strategic buyer who has found an asset that they want, and there is a unique circumstance where whether it's a competitive environment, where they're trying to take out a competitor, where they view they have a competitive disadvantage and they need to overpay, for lack of a better term, to make sure they secure their position in the market. But I think you're not going to see your financial buyers, I think, come in and overpay for these high-end Wall Street Journal eye-shocking multiples. It's really the strategics that can do that, that can realize synergies and actually, I mean, in more ways than one. It's not just going to be cost synergies, it's going to be revenue synergies. And I think that's one of the things that motivates some of these players for these big marquee eye-popping multiples.
Yeah, I just before going to Scott on this question, I want to add that the ones that get the really blockbuster valuations tend to have Matt Swartz at Pillsbury as their exit counsel, but that's a different correlation. So go ahead, Scott. What else is there besides that?
No, exceptional investment bankers. No, yeah. I mean, it's you can't predict those things, right? Like companies at those levels are bought, not sold, right? There's a set of factors, as Joe said, that aren't predicted, that aren't predictable when you go in there, and things. What I would say is in those worlds, the price that you'll sell a business is basically, whatever your buyer thinks they have to pay you for the owners of the business to give their option value. It's like, what are your away from the table options? So if you've got, an IPO option, which could be, like $20 billion, the buyer's going to look at that and say, what is you as a seller, your away from the table option for this business, and what do I have to pay you to give up that option? And that's what kind of drives those dynamics. It's not multiple oriented. Like when you say 15 times, I always get confused if you're talking about EBITDA or you're talking about revenue, right? Because like, a lot of those 15 times revenue is very blasé right now. It's like 30 times revenue, right? Which is crazy, but that's like the world that we're kind of living in. But those are the kind of dynamics from a value point of view that drive those, really extraordinary outcomes. And it all comes down to just, you have the ability to say no, and you have away from the table options, so people feel they have to pay it.
And Mitch, your thoughts. I mean,
yeah, and I was just thinking about the times when really we've had that happen within our market, and I think there's a couple things that the first is it tends to always be a market leader in whatever sector, whatever niche, whatever they're doing. The other time I feel like when you see it happen is when buyers start talking about valuation and sort of different metrics than you'd normally hear. And a lot of that, on the government side tends to talk about P-win in upcoming contracts, upcoming opportunities. We've got a $5 billion contract coming out. This will increase the win by 10%. We're backing into a value using sort of silly math, right? But I think that leads back to what Joe and Scott said. I mean, it tends to be very strategic. It tends to be kind of the timing sort of stars aligned, and it tends to be strategic buyers. And it's just right place, right time in a lot of ways. But we definitely do see it happen.
It's a hard one to plan for, but obviously great when it happens. I wish we had a lot more time. It's been a very interesting discussion today. So I'd like to thank Joe Greaves of BofA Securities, Mitch Martin of the McLean Group, Scott Stevens of Guggenheim. Really great discussion. Let's keep it going. Let's talk another time. This AirMeet platform, believe it or not, allows networking virtually, which I thank the NVTC for, but also hope that networking becomes a non-video screen thing soon. So thanks to you guys very much. Great job. Look forward to talking again.
Thanks, Matt.
Thanks, Matt.
Thanks so much, guys.